Welcome to this week's Q&A. We've got a question today from one of our viewers in California, and it's a little different because this particular gentleman said, well look, I'm not really concerned about my Australian investment property. I am concerned about my stock portfolio. So let's have a look at what lies behind that. And as we all know, everyone knows that the current theme of the moment is interest rates, rising rates, particularly in the US, but also in Australia. And we also all know that when we have rate increases, so increases to the official cash rate by reserve banks, that will impact the pricing of most asset classes, but certainly of risk assets. And if we have a look at things like Australian residential property, they're not really mark-to-market assets. So we've got lagging information coming through, and the price of that asset class doesn't actually vary on a day-by-day, hour-by-hour basis. However, if we look at things like listed assets, so equities in particular as another growth asset class, risk assets, they are priced minute by minute when exchanges are open, and therefore can react far more quickly to external macroeconomic forces like Federal Reserve or the RBA in Australia raising the overnight cash rate, particularly if they're going to do so very aggressively, as the financial markets have factored in. And we've seen over the course of the last week or two a really strong sell-off in bond markets around the world. So, you know, rates touching in Australia, Aussie 10-year yield touched 3.16%. That was last seen in 2014. And in the States, the 2-year yield has gone to 2.76% plus, and that's obviously in line with market expectations that the Fed is going to raise their overnight cash rate by perhaps 50 basis point increments or more at the next 3 to 4 meetings coming up, starting at their next meeting. So I can understand this viewer saying, look, I'm really more concerned about my share portfolio. But like with anything else, I always say, well, let's have a look at, you know, what is it that you actually own? Let's look at what stocks you own within that share portfolio, and to see how sensitive they are to what's happening with interest rates at the moment and what may be a likely outcome going forward. Because as we all know also, the NASDAQ index in the US has reached, you know, almost bear territory, down circa 20% year to date, whereas the S&P 500 is only 11%, and in Australia the ASX is only down 1.5% roughly. So we've got to look at all of those things, but it brings us back to mind that not all growth assets behave similarly, and real property and listed assets such as equities will actually act in a very divergent manner, especially in the shorter term. Long term is a different story, and it's something we can cover at another time. But in this instance, we've got to really keep an eye on these mark-to-market assets and make sure that people aren't reacting perhaps too aggressively to short-term changes in valuation. If you found this helpful, then please subscribe to our YouTube channel and click like. I'm Andrew Unterweger from Wise Guru, and I'll see you at next week's Q&A.